SPACs, or Special Purpose Acquisition Companies, are dominating the IPO scene. A kind of blank check company, SPACs raise money through an IPO to buy other companies. After a SPAC goes public, it typically has around 2 years to buy one or more companies. When a SPAC makes a deal, the target company becomes public, all without having to go through a traditional IPO. SPACs have historically had a bad reputation, in part because they lacked regulations.
They were viewed as kind of abusive to the investors, so the SEC came out with a whole bunch of rules limiting their use.
But in recent years, top-tier investors have been hopping on the SPAC train.
You started seeing a lot of these exciting companies use the SPAC as a means of going public. And then you saw the IPO numbers uptick dramatically to sort of 10 billion plus a year, where it stayed consistent for the last 3 years.
Private equity firms like TPG Capital and the Carlyle Group have sponsored SPACs. So have leading investment banks like Goldman Sachs. Household brands like Hostess and Del Taco went public by merging with SPACs. More recently, Virgin Galactic and DraftKings have followed in their footsteps. When the coronavirus pandemic rattled many IPO plans, SPACs kept going public. One reason is that a SPAC's value is tied to how much it raised from investors, so it's less susceptible to the ups and downs of the market. Investors might also think that a recession will lead to more buying opportunities for SPACs. SPAC acquisitions are also much less risky than traditional IPOs. If an investor doesn't like the company that a SPAC wants to acquire, they don't have to participate, and they still have the option to buy into the company at a later date at a set price.
You have very little downside and you have upside even if you parachute out of the deal.
The main risk for a SPAC is that the sponsors won't find an acquisition target that the investors agree to. But in a situation where the market is volatile and companies are in need of cash, many investors are betting that SPACs can fill a void left by traditional IPOs.
You have a view that the economy is going to improve over the next couple of years, and this is an opportunity to use the SPAC as a vehicle to provide capital for private companies that may need it, and you'll want to invest ahead of it.